Hello, this is Joe McPhail, CEO of WEquil Group, and today I'm giving a presentation on inflation and investing implications. I'll be presenting a slide deck that's titled Correlation Regimes, which our team put together back about a year and a half ago. But we've been waiting for a day like today to do this presentation. We've been moving toward supporting this thesis for a few months now. We first titled an article called Correlation Regimes back in September, and it appears as though we're moving in that direction. So I'm going to go ahead and share this presentation now. Here we go. How's that working? Okay, so correlation regimes. Single factor approach to evaluating financial assets. That single factor, spoiler alert, is inflation. So here's the background for this presentation is a study of the correlation between stocks and bonds going back all the way till 1871. And during that period, there were 6 correlation regimes. And those correlation regimes effectively are changes in the relationship between stocks and bonds. And the summary of this is that inflation destroys wealth by essentially causing the discount rate on basically all cash generating financial assets to go up. And so today is a good example of that, although one day is not a trend, certainly not a correlation regime change, just one day, but we're seeing increasing evidence of this general change in the relationship between stocks and bonds. And that'll be a core point that we're trying to communicate with this presentation. Okay, let's go ahead and jump straight to the exciting part, which is the charts. So here we have the correlation between the S&P 500 and 10-year Treasury bonds going back until 1881. The reason why it's 1881 is because there's a 10-year time period that's used to calculate that correlation. And this would also be a monthly correlation. And so if you do that calculation and you run this going back till 1881, you can see that there were some big changes in the general relationship between the S&P 500 and 10-year Treasury bonds. Typically, if you look just broadly, you actually have an average correlation of 16%. And 16% is positive. Generally, I think that the investors broadly think of the relationship between stocks and bonds as being negative. And the reason why that's commonplace in terms of investor understanding is because that's been the case since around the year 2000, based on the way that we're calculating this. But that's not the average. The average is actually slightly positive, 16%, not extremely positive. But what seems to be driving this, that was a big focus of our research, was trying to figure out what was causing these changes in correlations between stocks and bonds. And what we found is that the biggest driver was inflation. And you can see the blue line here is inflation. I can zoom in a little bit more here so it's a bit easier to see. The blue line is inflation, and that inflation number is also a 10-year average. And so you're getting smooth numbers with these. And you can see a pretty tight relationship most of the time between these 10-year rolling averages of inflation and also stock bond correlations that are calculated over the same time period. And you can also see that most recently, this period looks quite a bit like it did in the late 50s, early 60s, and then also during the 1930s. So here we are looking again at some additional data looking at the returns, stocks and bonds. So one of the important implications of moving into a inflationary regime is that while correlations are going up, they're usually going up because stocks and bond prices were going down together. So valuations tend to fall across the board for cash generating assets. And so this is illustrating that that change in that relationship. Now I go into some back testing here. So we were also looking at let's see, we have treasury bonds. We were looking at this particular period. More recently, what's been happening? Well, what's been happening since the 80s is that we've had falling inflation, but it's also become much more stable inflation. So falling and stable inflation, what this does is it allows for the idiosyncratic factors of individual securities, particular stocks and bonds, to have that price behavior dominated by those idiosyncratic factors. So, for stocks, changes in earnings, changes in revenue growth, profit margins, all of these things that play into an individual stock are going to drive that price. But stocks and bonds share this risk factor. They share this risk factor of the discount rate. And it's in inflation. The way that inflation actually really impacts this is by driving up these correlations by raising the discount rate. And so that's what we saw in the late 60s and also in the 70s. You saw this ramp up in yields, but you were also seeing rises in inflation pushing that up, and so that discount rate was also pushing down stocks. And so you actually saw like the low end of stock valuations being at the same low end for bond prices as well, basically around 1981. And then here we were doing some back testing by looking at some additional assets besides just the S&P 500 and treasury bonds. We were also looking at yield bonds. So these would be junk bonds. And you can see here that there was a general fall in the relationship between treasury bonds and junk bonds, as well as treasury bonds and stocks. So here we've got this falling relationship, as generally has been the case for quite some time, and I'll get into the implications of that later. I also show here that stocks versus the high yield correlation has actually been very high the entire time. So not as much there. I think part of that is really just that junk bonds are have a high degree of credit risk. And so because of that credit risk, they're going to have a lot more shared risk factor than, say, treasury bonds and high yield junk bonds. Okay, so given that inflation has this important implication regarding stocks and bonds generally driving both of these down, while also driving up the correlations between these two, removing some diversification benefits. Sorry, we wanted to focus in on, okay, well, what's going to actually cause inflation to rise? Like, what are the key components? And again, we put this together almost 2 years ago, but we really wanted to understand what some of these key pieces were. And I'm not going to go through all the details of these, but I'll go ahead and list them off and describe some of them. So productivity, this would be essentially how productive is the labor market, like how much GDP are you getting per hour? And so, improvements in technology and education and capital accumulation, all these things help with that. Independent central bank. So are central banks generally able to make independent decisions as opposed to, say, being under the influence of governments? Peace and stability would be another key factor. So if the world is peaceful and the world is stable, then you tend to see a lack of disruptions, like supply chain disruptions, like we saw in the trade war that we were having in 2018. Also today, the Russian stock market fell by 7%. One of the individuals in our brain trust was suggesting that there's a risk of actual warfare, potentially even involving other countries. So, these kinds of things are part of the reason why we're doing this presentation today. Also, wealth inequality and savings. So the more inequality there is, essentially the more there are people in the world that have a lot of cash. And so investing that cash tends to drive up asset prices. That would be another one. Which reduces consumption as well. Low government expenditures to GDP. So that's certainly not the case today. You have a lot of government expenditures. This is another reason why we're concerned. And then also international trade. We've had a long period of international trade essentially driving up trade as a percent of GDP, starting with the trade war that started to turn. And it appears as though that's continuing to reverse itself after a good 30, 40-year period of increases, basically since the end of the Cold War and the addition of trade agreements. And then also the absence of supply shocks would contribute to low, moderate inflation and higher corporate profit margins. Basically suggesting that corporates don't need to raise prices if they have wide profit margins. So all of these are like the major factors that our team was putting together to try to wrap our heads around when we would want to pull the trigger on implementing a correlation regime style portfolio and having more concern about rising correlations between stocks and bonds being driven by inflationary pressures. So inflation drivers, so productivity. So productivity has actually been lower since basically since the financial crisis. For quite some time, inflation or productivity was around 2%. Before the pandemic, there was a lot of discussion amongst top economists about why it seemed like productivity was sluggish. Many different theories were put out there. It's too early to tell what kind of impact the pandemic is going to have on productivity. This really isn't a key driver of our concerns with inflation, but it is an important one. So Kathy Wood and some other commentators are suggesting that productivity is actually going to increase as a result of technological innovation from the pandemic. We actually agree with that view. So you would put this maybe in the camp of something that would help to try to push inflation down in terms of the first out of the 8 risk factors. At least that's the way that we see it, although time will tell. Okay, the next one would be independent central bank. Keep in mind that we did put this together about 2 years ago. And so some of this might be a little bit dated. We're going to be updating this for our coming newsletter, which we're going to publish tomorrow. And so we'll be adding to this throughout the year and probably for many years to come. But there are some concerns about the independence of central banks. And I'll point out just the one big change is that if you look back historically, there wasn't nearly as much transparency into what the Fed was doing. It wasn't you generally did not have folks like Powell, going up in front of Congress and being grilled. It was much more of the Fed's going to do what the Fed's going to do, and they weren't even announcing where they were going to be setting rates. That's something that's more recent. In the past decade, prior to that, basically the way that market participants were viewing what the Fed was doing is they would actually just look at market prices. You could look at yields on bonds to try to see, what the Fed was doing. So there has been quite a bit of pressure on the Fed. This particular quote's coming from our former president in the United States, who was attacking, who was making some sharp attacks against the Fed. So that's one thing that we've noticed, is that it seems as though the Fed is under a lot more scrutiny than before. So we would put that into the category of being more inflationary, because if the Fed feels beholden to governments, then the governments can have influence over that. An example of that today would be governments spending trillions of dollars and not necessarily trying all that hard to balance budgets, and feeling as though the Fed's job should be to come in there and buy up all this debt if global market participants do not. Okay. Peace and stability. This is coming from one of Ray Dalio's articles, and this is really looking at the emergence of populism. How you measure populism is, of course, really challenging. And there's, I'm sure, all kinds of subjective assumptions that he was making while he was putting this together. But the general thesis that we have on peace and stability is quite similar to Ray Dalio at Bridgewater's thesis, essentially focusing on long-term debt cycle. The more inequality you have, the easier it is for, at least historically, the more inequality, the more you tend to see a lot more anger and frustration between those that you might fit into the category of labor versus capitalist. And so, words can be challenging here to use to try to describe what's happening, but generally the more inequality you have, the less stability. Then you also have rise in China, you have events in Russia today. You also, I think, just generally, if you look at the United States having roughly 24% of the world's GDP, well, right after World War II, the United States was half of global GDP. It was a lot easier for the United States to play a global policeman, but essentially ever since the end of the Cold War, there's been a move for the United States to slowly move out of playing that role. How much of an impact this ends up having on the global system and structure and power, I think it's difficult to say. But one thing's for sure, and that is that the United States is not as powerful relative to the rest of the world as it was before, when we basically had this post-World War II, the beginning of this very long period of peace and stability. So we're pointing out these factors as reasons to be concerned about stability. And because of that, this would be another thing that could potentially be driving inflation now and then also in the future. Wealth inequality. Okay, so wealth inequality is another example or another driver of this. And the reason why, beyond what I just mentioned, is that if you have a lot more wealth that's being concentrated, then that wealth tends to not be spent. And one big thing that happened during the pandemic is you had to move into a new form of stimulus where goes by various names. Some people call it helicopter money, where essentially checks were being mailed directly to people. When you mail checks en masse to people, and you're not doing this through, say, quantitative easing, where you're buying bonds, typically it's people that have more money that own those bonds. If you're using that mechanism to be driving wealth, or to be driving stimulus, then it doesn't tend to be nearly as inflationary, because giving people that have more money even more money doesn't tend to translate as much into more spending. That's certainly not the case now. There was quite a bit of money that was being given out, not just through direct payments, but also various kinds of government assistance. And so since the reopening, that started to move into the broader economy. And so as we're looking at that kind of almost forced redistributive effects, then that should also be inflationary, because you're putting more money in the hands of people that are going to spend it, but you're not necessarily increasing the productive capacity of the economy to actually produce more goods and services. Okay, so, and this is actually a little bit old, but the line here is probably about accurate in terms of where we've been going. So, low government expenditures as a percent of GDP. That is most certainly not the case today. So we have been doing unprecedented amounts of deficit spending, even more so as a percent of GDP than we were when we were fighting World War II. And so, given that, that would be one of the many sources of inflation. The way that this causes inflation is that you're essentially just increasing the demand for goods and services through the government, but you're not necessarily increasing the capacity of the economy to produce more of those goods and services. Typically, the U.S. government doesn't do as much productive spending. That's typically happening in the private sector, and so that's a big reason why having large government expenditures as a percent of GDP and high deficit spending tends to correlate with higher inflation. Okay, and this is just another graph showcasing this government current expenditures as a percent of GDP. Okay. Oh, this is interesting. Yeah, let's go ahead and take a look at this. So the 1965 to 1980 period is broadly known as the Great Inflation. So we spent an awful lot of time trying to understand what was happening during this period. The 70s are often referenced as the inflationary period, but it actually started in 1965. So President Johnson signed the Social Security amendments, boosting spending on Medicaid, Medicare. But there was also just a whole lot more going on there than just that. So that was the beginning of seeing this ramp up in government expenditures as a percent of GDP. And you can see this overlaying with the CPI, and that essentially was the beginning of the end of the last low to moderate inflation cycle prior to the one that we appear to be exiting right now. Of course, it's difficult to draw parallels to history. There are a lot of other things about today that are quite different than 1965, but this is an important data point. International trade. Okay, so essentially since the end of, you've generally seen a rise in international trade for many reasons. It was really accelerated by WTO, NAFTA, and the emergence of China. China was huge in terms of one is it was increasingly putting the United States labor market in competition with China. And because Chinese wages were so much lower, this for the past few decades, this has really been one of the reasons why the United States hasn't had a steady rise in real wages, is because of this competition with China. But international trade was also quite helpful in terms of driving down prices. And so, if you're allowing countries around the world to trade, then the countries that are better suited for producing certain kinds of goods and services are going to be able to supply those to the rest of the world at a cheaper price. And so, coming out of the Cold War, allowing for more of this trade through these trade agreements, all of these things help to increase international trade as a percent of GDP. And these things also lend themselves quite well to move out of that inflation period of the 70s and into the low, moderate inflation period that we've had for the past few decades. Okay. Another one would be supply shocks. So this is quite interesting. So equities versus commodities. Commodities tend to move in these cycles because well, they're quite capital intensive. So to give you an example, lithium mining companies tend to take many years to actually come online. That would actually be, you know, one of the longer time frames. But even other kinds of commodities, copper, iron, silver. If you're going to all the permits required, actually uh, changes in government policy over the past few years have actually been making it harder for companies to be able to increase their supply of commodities. We recently put out an article about Rio Tinto, for example, and talking about some of the impacts that this was having on their ability to try to increase production of raw materials. But because it takes so long to bring these online, you tend to see basically regimes in commodity prices. And these commodity price regimes, they don't always coincide with inflationary regimes because it's only one of many factors, but it's a really important factor. And so, for example, you know, going into the last inflation period, you know, it was these oil price shocks, oil crisis of 1973, 74, that was most certainly helping to facilitate even more inflation concerns during that period of time. Well, if you look at what we're experiencing right now, basically heading into the pandemic, we had been going through a more than decade-long period of falling commodity prices. Um, uh, Supply shocks are mentioned here because one of the most important commodity in the world is still oil, and it was these oil supply shocks that can still have big impacts. But now, you know, this is broadening out. Supply shocks generally have been causing inflationary pressures. So it's not just specific to commodities, but commodities have definitely been part of this. You've seen huge spikes in lumber prices and copper prices. And well, why is that? Part of the reason why is because when the world was shutting down and sporadically continues to shut down in various places, um, commodities are part of the supply chains that end up getting disrupted. And so to the extent that we continue to see those disruptions, that's going to cause inflationary pressures. But even if we do not see, say, overt shocks to particular commodities like we have in the Middle East, we have gone through such a long period of lower and falling commodity prices that the actual productive capacity to increase that is well, essentially it hasn't been a focus for these companies, right? Who's leading the companies that are the commodity producers that are helping to facilitate the electric revolution, being able to supply all the copper needed to help with the emerging world getting online. So electrification is huge in this space because it's driving up demand for metals, to try to be basically moving into the electric space and taking some market share from oil and natural gas, right? These things take time, and the companies that are going to be doing this just are not used to being in an environment of rising commodity prices, and so it's going to take a while to transition to that. So we see commodity prices and commodities generally as being in the beginning of a longer bull market, and this is only going to add, in our view, to these inflation pressures. Okay, here's another example of supply shocks. So again, we put this together a couple years ago, and since then, this has only gotten worse, way worse. So what are we seeing here? Well, we're seeing annual work stoppages. So this would be people that are on strike and refusing to work and basically demanding higher wages. And we've started to see the beginning of this coming back. One really good example would be John Deere. They committed to some pretty hefty wage increases going out many years into the future. And that was a bit shocking to some people. It wasn't shocking to us. and that's probably going to continue. We're basically starting to see more of a shift toward labor, in part because of these global supply chains coming apart a bit post-trade war, post-pandemic, more reliance on labor in the United States. That's putting labor in the United States back in the driver's seat. And you're seeing that with the great inflation, you're seeing that with the startup boom, and you're also seeing that with demands for higher wages, and that's starting to show up more and more in data on work stoppages. Okay, high profit margins. So essentially, the higher profit margins are basically what this is saying is that companies have more. They're not under as much pressure to raise prices. So what we're looking at here is corporate profits after tax as a percent of GDP. So the higher those profits are as a percent of GDP, you know, you're generally looking at having that's one way of measuring. It's not my favorite way, actually, but just generally, if you're looking at corporate profits in the United States, they've been doing quite well. That's in part because wages have been lower, and so technological innovation's also been a big one. So a lot of the biggest increases in these profit margins have actually been coming from like the FANG stocks, these big companies that have huge network effects, and arguably in some ways are like have qualities of a monopoly. I don't want to say that they are a monopoly, but they certainly seem to have of characteristics that are similar to, say, like waterworks and electric company. These things tend to allow companies insulated from raising prices. But to the extent that we see higher wages pushing up against that, we could start to see those profit margins compress. And that's what we're expecting. We're expecting corporate profit margins to generally compress because of tighter labor markets. And so we've basically got a long way to go down, is the general takeaway from this last point. Okay, and then there are quite a few other points here, but let's go ahead and just touch on these key inflation drivers. So inflation's been falling for 35 years. That's one of the reasons why we thought it was so important to put together this deck, put together all these various details so that we could be ready to go if we started to see this inflation regime turn. And when we published, internally published this for ourselves a couple of years ago, we saw that the inflation outlook is uncertain. Inflation could stay lower for longer. However, it is also entirely possible, perhaps even likely, that inflation begins to rise about above the central bank target of 2% in the near term, and that's certainly what we're seeing today. That's where we're at today. Before getting into this evidence of the bond bubble, this is getting into investing implications. I just want to point out one of the other factors that I think is likely to drive up some, drive up in at least in the near term, is just that fear of inflation tends to drive more inflation, and so. We saw some of this already where there was a pull forward, it seemed, in terms of purchasing. And so if investors are concerned about inflation, then investors are less likely to buy government bonds. And right now the Fed is looking at, they're actually moving into tapering quite rapidly. So they're down to about $60 billion a month now. That's half of what it was 2 months ago. And so if we're right about inflation being more and more of a concern for investors, then, well, it means that as the Fed's moving out of the QE space, that there aren't going to be investors broadly that are interested in filling that vacuum, given all the deficit spending. And so if we're right about that, then we believe that we're going to continue to see higher yields on bonds, because you're going to need a lower price on those bonds in order for the market to clear. And that's an important point to make as we segue into looking at evidence of a bond bubble, uh, which uh, which we basically see bonds as being in a bubble, and we think that now is the beginning of that bubble really bursting. That's why we're doing this in this presentation today. Actually, this appears to be the beginning of that recognition that bonds have actually been in a bubble for quite some time, with negative yielding bonds being something that was a totally new phenomenon that didn't exist for 5,000 years until basically after the financial crisis. And so um, that's kind of how we're viewing that market right now. Um, let's go ahead and take a look at evidence of this bond bubble. So this right here is the CPI and 10-year break-even inflation rates. You can hear that basically since 1980, bonds have been in this bull market. Well, bonds have been in this bull market, but it's because you've had this drive down in inflation expectations. It's just been going down, 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 and the amount of volatility in this has actually been getting quite small all the way up until recently. And I'm going to keep moving forward here to this slide here. So one of the things that we've noted is that some parts of the world, especially in Japan and in Europe, you actually have these extremely low and often negative interest rates on government bonds. And part of understanding this bond bubble is understanding the rationale behind that, like why is that, and why is it that the United States did not have that? And a big reason why appears to be that central banks are, for the most part, driving a lot of the price action for these government bonds. And so in Japan, the amount of government bonds that are owned by that central bank at the time of this, I think we put this out here a couple years ago, that the central bank itself owns over 40% of all of the bonds in Japan. And it's not just the central bank, it's also banks that they regulate. And so the influence of the central bank is actually much larger. Now, if you look at the United States, it's actually quite a bit lower. It's only 20%, and part of the reason why is because U.S. government bonds and the U.S. dollar more broadly, this is a global global reserve asset. It's 65% of the central bank reserve portfolio on average across foreign central banks. And so, the price of government bonds in the U.S. is really set by the global market. That's not really true for Japan, for example. But the key question now is, as the central bank here, the Federal Reserve, moves out of this market by rapidly reducing their quantitative easing program, the key question is, okay, who's going to move in here and who's going to buy this? All right, is there a market at these low yields to continue to facilitate purchasing all this U.S. government debt? And we're working on a paper called yield curve targeting, where we're actually arguing that that's not going to happen. That's our spoiler alert. It's a 25-page paper, but we just don't see any rationale for why investors would want to be buying government bonds. Certainly, like 10-year Treasury bonds at below 2%, even below 3%, doesn't really seem like it would make any rational sense given the CPI prints and all the inflationary pressures that we're highlighting here. And so if we're right about that, then it's going to be extremely challenging for the Federal Reserve to maintain a policy of not intervening in this market. And so basically the way that this seems like it's headed is one in which the United States starts to look a lot more like Japan in terms of how much of that government debt the Federal Reserve owns. And that would probably happen, in our view at least. We believe that would happen in the context of some kind of yield curve targeting. Okay. Oh yeah, this is one of the charts that we pulled up here, was looking at the percent of euro denominated corporate bonds outstanding with negative yields. I think that in 10 years time, it's going to be really obvious to everybody that bonds were in a bubble. I think the only reason why this is even the slightest bit controversial today is that bonds have been in this bull market for so long, and we've had some of these anomalies like this one for so many years now. It's basically been like 5 years since we've seen things like this, that we've become complacent in understanding exactly what this means. There's absolutely no reason why really any corporate should have a negative yield, let alone a high yield. The history on debt goes back over 5,000 years, and in that history, there is no recorded instance of anybody ever lending to anybody else and getting and actually paying that person to lend them your money. So yeah, trying to make the case for bonds being in a bubble to me seems like a little bit silly, given how obvious some of these risk factors are right in front of us. But I'll keep making the case here. One of the real big issues is also that these bonds are not only negative yielding, but a lot of them have longer and longer durations. Here's a good example. So if you look at U.S. corporate bonds, and I think it's worse now. Some of this data is a bit old, but if you look at the average maturity on corporate bonds in just the United States, generally the maturity's been getting longer and longer and longer. And you've seen other evidence of this too in foreign markets, emerging markets. Some of these governments in emerging markets are starting to issue 50 or even 100-year bonds, just like governments in Europe started doing just over the past decade. That's really quite ridiculous. There's just no reason to do that. But because the maturity on bonds has been getting longer and longer, the actual amount of sensitivity to these bonds to inflation has been getting higher and higher and higher. Okay. So I'm going to go ahead and just hop over here to some of these investing implications. And I'm not even going to quote from the deck at this point. I'm going to go ahead and stop sharing this, hop back, and just talk to you all for a little bit. So that was a lot of information. I think that some of the most important takeaways from this are, one, that stocks and bonds have not historically had a negative correlation. That's something that's happened in the past 20 years, 20, 30 years. And the extreme negative correlations that they've had were because inflation was so muted. And inflation was so muted in large part because the world was very stable, because we had more and more trade, technological innovation. A lot of that, this long period of peace and prosperity was also increasing inequality, because it was, especially with the help of software, this basically allowed for more and more accumulation of wealth. But it tended to be in the hands of the capitalists that were, taking a lot more of the risk up front, and the entrepreneurs and folks that were making these investments to grow, as opposed to labor competing with China and other markets as the world became more flat. So because of that, you had a lot more investment in new technologies, but that money wasn't necessarily spent on actual goods and services. Many factors were leading to one of the longest periods of peace and prosperity and stability that there really ever has been. Now, given that, the nature of how stocks and bonds and junk bonds and other kinds of cash generating securities, the relationships that these have had over the past 20, 30 years is one that doesn't really reflect history. And that could be because we're in a new world and this time is different. And you know what? There are good reasons to think that a lot of things are different today. But there are some risks. One of those risks is that everything from target retirement funds to risk parity funds to value at risk models at banks and hedge funds, a lot of our financial system and the way that we invest is built on this idea of a negative correlation between stocks and bonds. And days like today, if they are more persistent, if we're right and these things are more persistent, there are a lot of players in the market that are going to be caught flat-footed. And so we wanted to put this out there for our followers, our subscribers, to try to help you to better understand, why this is happening, what are the causes, what are the risks, what does this mean, why is inflation important, how does it impact asset prices. We wanted to come out and try to share some of this with you, even before we come out with our newsletter tomorrow, so that you could try to get ahead of some of this. If you're interested in learning more about our research, you're welcome to go to WEquil.com. And if you read our welcome letter for WEquil Capital, we have a Discord where we chat with members. We can also, if you go to Twitter and subscribe, our first newsletter is going to go out tomorrow. So we're quite excited about that. We've got a lot of research in the pipeline that we've been preparing to share with you. We also have a happy hour on Thursdays that you can find on our website as well. So I hope you appreciate the presentation today, and thank you very much to the team for helping to put this together and sharing all of your insights. It's been really incredible. So yeah, thank you very much, and have a good night.